4 of the biggest software stocks on the planet just went through something that looks a lot like a medical anomaly. Picture this: full workup, pulse steady, blood pressure normal, reflexes sharp. Every vital sign comes back exactly where it should. And the doctor looks at you and says, "I think you're dying." And that's essentially what Wall Street is telling Adobe, Salesforce, ServiceNow and Atlassian this year. All of them beat their earnings, all of them got crushed anyway. We are looking at Adobe, who dropped 45% this year alone, Salesforce 26% only in the January-February sell-off, then ServiceNow is trading 52% below its all-time highs, while Atlassian dropped from its peak as low as 88%. For 2 decades, software companies were priced on one assumption: you pay per seat, and the seat number only goes up. Then AI agents showed up and the market flipped that assumption overnight. If one agent replaces 10 employees, why would you keep paying for 10 seats? That fear reset how the entire sector gets valued on a diagnosis nobody's actually confirmed yet. So by the end of this video, I'll walk you through the same vitals the market skipped and show you why I think the diagnosis might be wrong and exactly what needs to happen to confirm that it is wrong. So let's start with the 4 companies actually caught in this, what they're building, and whether what's happening in the business matches what happened to the expectation. And Adobe's stock says failing business. Adobe's numbers say something else entirely. Revenue up 13%, record quarter, guidance raised, and the stock fell anyway. Now, what is driving this? Firefly, their AI product line, tripled year over year. Yeah, it's not AI bolted onto old software, it's a new business customers are paying for on top of everything else. All of this trading under 10 times forward earnings against an average in the 30s. Priced like it's dying, reported like it's thriving. Interesting, right? Now, we got the fundamentals perspective, but do the technicals, does the chart back that up? Let's find out. So Adobe is in a very established uptrend. The correction has been going on for nearly 5 years, and we see 3 waves down. This does suggest a pattern, a correction that could be complete. But we need to go in the smaller time frame to identify whether this is reliable, because while I can identify this as an ABC within a wave 4, and the wave C could even be considered complete, we do have 5 waves down that we could theoretically track. The structure very easily allows for further extensions. The larger time frame perspective holds nothing against this. It would still have room within the area of support. It extends down to $126. And the structure, the internal pattern, is suggesting it to be the case that the correction is frankly not done. Now, we won't base this expectation on the pattern alone, and if we see evidence that a bottom would be in, I will be the first to look for an opportunity here. And what I'm tracking within this wave C has to assume the possibility of a further decline. Again, it is possible for this structure to be complete, and that is why I'll be tracking within a different color this continuation lower, but without seeing the break of resistance, a break above the 50% retracement level in this orange box, $284.60. I still have to expect that this structure will continue lower. I have to expect that the bottom is not yet in. But if it manages to do that, the most relevant level of resistance would have been broken. And it would open the doors. It would enable Adobe for the capability of having a bottom in and seeing the next wave up unfold to new all-time highs. If it manages to get a sustained break above the 50% retracement here, we are looking at an extension, let's say from $300, we would be looking at about a 3x, very easily within this trend. I actually believe that to be in the very low end of what we would expect the wave 5 to be for Adobe, as the larger trend is suggesting this is right in the sweet spot where the wave 5 tends to get quite extended and often enough turn out to be as large as the wave 3 itself, if not even larger. We actually have a similar example within this internal development, where the wave 5 has been the longest wave. Now, what do we have so far? Do we have anything that would suggest the levels of resistance would get broken? Unfortunately, not yet, so it is a bit early. In fact, the structure that has formed in this area is rather suggestive of a 3-wave pattern up, which isn't favorable for the bullish thesis that would see a breakout. Doesn't mean it cannot happen, it certainly can build a larger 5-wave pattern within this as a wave 3, an extended wave 3, and actually build a quite healthy structure within this rally. But it needs to hold the current lows, where already if it breaks below $211, the possibility for an impulse to form would be gone. And to be honest, if it is to build a wave 3 in this structure, an extended wave 3, it shouldn't get anywhere close to that region. It did push into the 38.2% retracement, the ideal target for the wave 4, and we do have some structural support in this region between $240 down to about $225. If this region cannot hold, if we see a sustained break below it, it will be most likely the case that this extension lower will occur. So Adobe still needs to form a confirmation. Then some things to consider here. We got a CFO resignation, and management itself flagged that a shift toward freemium user acquisition will slow overall annual recurring revenue. Yeah, something to notice here. And that's about it for Adobe, so let's move on to the one name in this group that actually deserves a little skepticism. Salesforce beat by 13%. That's a headline. But strip out an acquisition, and the core business actually grew closer to 9% instead. That's the honest number, and it's the biggest real crack in this whole thesis. Now, what's covering for it? 7 of their top 10 deals last quarter added new seats. No cut, and that's the opposite of what AI kills the seat is supposed to look like. All of this is trading at 13 times forward earnings, so given the crack in the growth number, what's the chart actually telling us? Interestingly enough, Salesforce seems to have one of the most complete corrections of the bunch. It's one that allows a bottom to be in, and it's also tracking a wave 4, maybe just within a smaller timeframe perspective. Maybe where we actually do not need to see any further extensions to consider the proportions complete. So I would be looking at this to be a wave A down, a wave B up, and a C wave down, where I have 5 waves within the wave C, where I don't need any further lows, and all of the expectations could have already been fulfilled. Now, is this enough to consider that a bottom is in? Unfortunately not, and I can track all the same within this stock a 5-wave move to occur within this structure where a wave 3 would have just bottomed and the wave 4 would now be expected to form the development. It could have already topped, but that's not the point. I want to find confirmation. I want to find the levels of resistance broken to strongly indicate that this structure is indeed over, that this decline is done for, and we are looking for it to extend to new all-time highs once more. This means that it needs to see a sustained break above $209, the 50% retracement, where we also see some significant structural resistance in this previous stop within this region. And exactly as Adobe, it just got rejected at the 38.2% retracement, which is the ideal target for the wave 4, within a 3-wave pattern. Looking at this structure, we get a strong indication that the rally could be over and the 5th wave would be ready to form. So we actually have a very similar story with Adobe here, and likewise, if it manages to see the sustained break above the area of resistance, the likelihood of forming a bottom would be increased significantly. And in addition to that, I will give you an even earlier but slightly weaker indication that we could see this stock succeed, and that would be from it forming a double 1-2 setup in this area, where if we see the next extension higher, we would have too many waves to consider a clear 3-wave pattern, And it could be a good enough suggestion that we will see the stronger breakout, that we will see this structure extend into a wave 3 of an extended wave 3, and it would eventually build the initial 5-wave move to the upside that would allow an even larger confirmation that a bottom would indeed be in. And if Salesforce is the shakiest case here, ServiceNow is the cleanest reversal in this story. Subscription growth didn't just hold, it re-accelerated to 23%. What do you think that means? Do you think that's what a business getting replaced by AI agents looks like? No. That's not supposed to happen if the thesis is right. It got an astounding renewal rate, 98%. Practically nobody's leaving, and the stock is trading at roughly a third of its 5-year average multiple. Then, with guidance raised, the fundamentals just made their case. But here's what the price action says. ServiceNow has probably one of the most capable structures to see new all-time highs. But that doesn't mean that a bottom would be in, and seeing those levels would require an extension that is not necessary. You see, for this stock, we actually already have 5 waves to the upside, and this 5th wave seems rather complete, doesn't seem like it needs any further extensions. Now, does it mean it can see extensions? Of course, and that's exactly what I'm tracking in this higher area of support. I'm tracking an internal wave 1 up and a wave 2 correction. But this thesis only holds its high probability interpretation as long as it does not get a sustained break below the 78.6% retracement, $88.80. So far, it's doing well, and even if it has seen the break, it's not been sustained. It has recovered. But if that happens, the probabilities shift, and if we see the break below the beginning of this entire rally, that's supposedly a wave 1 in yellow, the implication is that the setup would be invalidated, and we would have to pretty much look forward for the wave 2 correction to happen, where the first level of support, the first one, starts at $52.60. I believe this also puts into perspective the implication of seeing a decline in the broader sector. The implication if these stocks cannot manage to rally now and see a stronger than anticipated decline. And most often, these patterns, these corrections, do tend to reach their levels of support. That would imply more than 50% downside from the current levels. So what's the success story here? Well, we are looking at the smaller time frame, and again, we need a confirmation. We need to see that this is actually not going to extend lower, a risk that right now is actually quite increased, and we are looking at this structure to potentially be just an A, B, C pattern, but it could see further lows, and in that case, unless it sees a break above the previous swing high at $139, we are looking at a decent amount of risk that this would instead form either a 1-2 within this structure, where right now, the wave 2 could be complete. It already fulfilled all of its minimum expectations, it has 3 waves up, and it hasn't broken any of the relevant levels of resistance. It just pushed into the 61.8% retracement, so the doors for extended lows would actually be quite open and maybe even preferable in some cases. I'm not saying this bearish thesis will follow now, but it needs to deliver a confirmation. And for me, the break above the previous swing high, $139, would be it. And one honest caveat here. Some of this quarter's beat came from federal deals pulled forward from Q3. It means the numbers may be a tiny bit misleading here when it comes to the surprise. And we've got one more before we wrap everything together, before we package and put a bow tie on this. And this one is Atlassian. It got hit the hardest out of all 4, down 88% for a moment from peak to bottom, and even now it is trading at a discount of 78% from its all-time highs. But look at what actually happened to the business. Cloud growth accelerated to 29%. More seats in Jira, in software development. The one place AI is supposed to be replacing people fastest. And you could argue the chart says dying, but the seat count says otherwise. So we've established this is the biggest drop of the 4. But let's see if the chart agrees it should have been. And what I like here is that we have no options for interpretation. Having no options increases the confidence of the path we expect to be followed. And we have a wave 1 up, we are looking for a 3-wave correction, and we have the ultimate levels of support that we expect to be held. 78.6% retracement, $35 is the line we do not want to see crossed, and if it does, at the very least, we do not want to see a sustained break below it. Now, in terms of the pattern itself, unfortunately, it does still have room for downside. We can track this as a sharp decline within an A, B, C pattern, and within this wave C, we actually have an interesting caveat here. Within this first decline, we have a clear 5-wave pattern. It gets followed by what could be considered another 5-wave pattern, but what seems even more likely is that this would have been a 3-wave pattern down before the large drop, before this massive clear impulse. What does this mean? Well, I'm looking at this structure to have potentially built the strongest wave within a wave 5, and if you weren't to consider this, you could argue that resistance has been broken, the 50% retracement has been cleared off cleanly. But if we are to actually have a more open mind and consider that when you're left with one option, no matter how improbable it is probably the correct path to follow. And in that case, I would consider this to have been a wave 1 down, a wave 2 up, a wave 3 down, a wave 4 up, and a 5th wave that could still allow extensions lower, where in this interpretation, the 50% retracement would have been reached, but not broken. In this interpretation, the 5th wave could already be in formation. And interesting to note here, out of all 4, this is the only one that didn't form a lower low or a reset to consider within this decline. It only formed an internal correction, and despite it being the stock that dropped the most, it has one of the best chances in terms of the pattern itself to see the reversal, to see the rally, to see the break above resistance, because right now, this is all it needs to do to get the sustained break above the 50% retracement, $117, and it does actually need to take out the previous high, which sits more around $119 for this to be truly more reliable. Now, what are the expectations here? Well, again, we have a very interesting perspective because this stock is the one that could be considered to have built a 5-wave pattern. This stock is the one that could track already a confirmation that a bottom is in, and the levels of support to consider for such a possibility would push down to $65.70. Now, within this interpretation, my primary expectation and my preferred outcome would actually be to get a reset within this wave 2. Would actually be to see this as a larger A, B, C pattern, and this would play well here. We have only 3 waves up. And I'm not saying it cannot see a direct breakout, but it is preferable for this correction to extend a bit more. It is preferable for a reset that I would not consider would need to be the 5th wave in orange. Out of all these stocks, this one has the structure that kind of struggles the most in terms of a likely path, a likely probability for it to extend lower. It's not that common to get such an extended wave 5. So where does that leave us? Well, it is a bit early. We do not have a clear indication that we will see the breakout. And if you intend to have any attempt here, do keep in mind, earnings report the 6th of August. So we've got 4 different companies, 4 charts. Now let's zoom out and look at what all of them have in common. Well, all 4 of them are priced like they're shrinking. None of them are. Adobe can be tracked at 10 times forward earnings. 5-year average sits at 30. ServiceNow, current around the 26 to an average of 67. But here's the thing, that's not a discount. That's a bet that the future looks nothing like the past 4 quarters. Then revenue's up across the board. Earnings are up even more. And if AI were actually eating these businesses, you'd see the opposite. Discounting, squeeze margins, companies fighting to keep customers. Instead, they have more pricing power than they did a year ago. Guidance backs it up. Adobe raised its full year numbers, and ServiceNow raised guidance twice this year. I won't pretend it's a clean sweep. Salesforce's own full year guide landed slightly below what Wall Street expected, and ServiceNow's next quarter guide came in under consensus too. But raising your own forecasts isn't something that a management team does when it believes its business model is breaking. Now look at the whole group put together. Since 2016, combined revenue across these four is up more than 8 times. Price is up just over half of that. It didn't get there in a straight line. The price certainly ran way ahead of the business. It's had a huge discrepancy. It was priced for growth that hadn't happened yet. Then it cracked. It recovered, and now it's rolling over once more. It's further behind than at any single point on this chart. This is a historic price difference between the earnings and the revenue. 2 straight years of the price falling behind the business it's supposed to be tracking. That's not a one-quarter panic. That's a trend. So the market has decided these 4 companies are on the way out. But here's the number that should make you question that. 98%. That's ServiceNow's renewal rate. Out of every 100 customers up for renewal, 98% stayed. And if the story going around were true, this is exactly where it would show up first. Not in revenue, which is backward looking, but in renewals. Customers deciding right now whether they still need this software. And they're saying yes. Then there's a second number that goes even further. Take your existing customers from a year ago, ignore every new one, and ask how much money they're paying you today. ServiceNow is saying that number is 120 to 125%. Atlassian, 120%. Reason, 3 quarters in a row. Existing customers, the exact people who supposedly should be cutting seats, are spending 20+% more than a year ago. And Atlassian's is the one that really breaks the story here because they sell to developers. Ground zero. Instead, their cloud growth accelerated to 29%. And here's the simplest way to think about what's happening. The market looked at the chart and pronounced the patient dead. But before you accept a diagnosis like that, you check the vitals. Still beating every quarter, all 4. A low blood pressure, climbing, not falling. The grip strength, 98% renewal, 120% plus net recurring revenue at 2 of the 4. Reflexes, that's guidance, raised twice at ServiceNow, raised at Adobe. 4 vitals, all normal or improving, and the market's still writing the obituary. Now, this video would be incomplete without addressing the bear case, because it isn't stupid, it's just early. The mechanism is real. AI agents genuinely can do parts of what these platforms are built for. Task automation, ticket routing, first draft copy. An agent can do pieces of what the human seat used to do. And Gartner's own research says task-level work is vulnerable. That's not spin, that's people who advise enterprise software buyers for a living. So here's the honest version of the risk. None of what we just covered proves this doesn't happen. It proves it hasn't shown up yet. Renewals are a trailing signal. They tell you about contracts signed months ago, not decisions made this week. If you are the market and you genuinely believe these companies are dying, what would you expect that's different from what these 4 companies are actually reporting? Because right now, there is one vital sign already flashing yellow. Salesforce core business, stripped of its recent acquisition, is growing at 9%. The slowest of the 4, and the number in this entire video that actually supports the bear thesis rather than contradicts it. Now, the honest timeline, if the seat compression is real, it plays out over renewal cycles. 12, 24, 36 months out. Not in a single earnings sprint, which means the market may be pricing in something true, just years before the evidence can possibly confirm it. That's not irrational, that's just a bet nobody can settle yet. And to be fair here, nothing in this video, not even the charts, actually showed confirmation. Not the vitals, not the earnings, not the pattern. I haven't seen anything yet that tells me the market is changing its mind. And this is never meant to be financial advice, but this is exactly why this isn't framed as a buy now video. It's here's the case, here's what I'm waiting for, here's the confirmation I need to see. Everything here points in the same direction. These businesses are healthier than any price says, but I do not think the story is finished. The correction might not be done. It could go lower before it goes anywhere else, and some of the sharpest patterns here certainly still allow for that. That's the actual plan, not a hedge. I'm not calling a bottom. What I'm watching for is confirmation. And something telling me that the market's starting to agree with what the numbers already say. Until that shows up, this is a thesis, not a position, and what that confirmation looks like. I'll be sharing more of it as it develops on Patreon. Maybe we'll even do an update in the future. But what I won't do is tell you what to do with this. You know your own strategy, your own risk tolerance. I've given you the case, the vitals, the mispricing, and the honest risk. What you conclude from it is yours. Your call, your strategy. So we've got beating numbers, expanding margins, customers renewing anyway. The market's still pricing them like the story is true anyway. Maybe it is, eventually. But eventually and right now are different trades, and I know which side of that gap I'm watching. So for now, we will stop here, but if you want even more from me, you can check out the Patreon. But these are the levels, this is the trade setup. I hope you enjoyed the video, and if you did, don't forget to leave a like, subscribe, and if you enjoyed the content and want to support it directly, check out the channel membership, and I'll see you in the next one. Bye bye.